Hi, folks, and welcome to the Meaningful Money Podcast, Season 14, Episode 6. This is the podcast dedicated to helping you put your finances in order. My name is Pete Matthew, and I'm going to share with you everything you need to know and everything you need to do to secure your financial future. I'm here to help you make sense of money. Whoop, whoop. Here we are. Great to have you with me. Love doing this. Love getting behind the mic. 324 episodes into this podcast. I'm still having as much fun, more actually, than I've ever had before. And that comes down to you folks listening. Thank you so much for joining me once again. Now, as new accumulators, that's the title of the season that we're in. As new accumulators, we need to understand that when we invest, what's actually happening is that we are converting our cash into assets, and we hope that those assets will increase in value over time so that we can beat inflation, meet our financial goals. So we need to spend some time today discussing what those actual assets are. What is it that we're buying as investors so that we know what we're getting into. So that's where we're going today. After the main body of the show, I'll look at a review that's been left, talk about what we're going to be discussing next time. But before any of that, remember, this podcast continues to be brought to you with the help of my friends at 7 Investment Management. They've been helping me out here since the spring of 2011. Literally could not have built this to what it is without their help, their financial support over the years. So I'm really, really grateful to them for doing so. Please do check out what they're up to. They're at 7im.co.uk. That's the number 7im.co.uk. And also don't forget the Meaningful Money branded self-investment platform that they've built. So that is meaningfulmoney.tv/podcast-invest. meaningfulmoney.tv/podcast-invest. Those of you watching on the video, it's at the bottom of the screen right now. So definitely check that out. So, real assets. That term can be a little bit misleading. Obviously, it applies when it comes to gold or property because we can sort of see and feel those things. We can even step inside a property. Shares and bonds, though, they are just as real, even if our experience of them is more numbers on a statement or evaluation screen. Okay, so let's dive in and get real. We're going to be spending more time, I think, than we might normally do in the what you need to know section today, but that's okay because we need to learn some stuff. So remember, notes, links, all that good stuff, all at the show notes. It's the only link you need to remember, and it's meaningfulmoney.tv/NA6 for new accumulators, episode 6. meaningfulmoney.tv/NA6. Let's have a look at everything you need to know. Okay. Firstly, we need to understand the key difference between cash and real assets. All right? I always correct people whenever they talk about money that they have in savings accounts or premium bonds as investments, as in, I have investments in premium bonds. You imagine if I'm correcting people on that, I'm no fun at dinner parties, right? It's not because I'm a pedant, even though I am sometimes. It's because actually there's a massive difference between money held in the bank and the real assets that we're talking about today. Cash in the bank can never grow, right? £1 sterling will always be £1. Now, in a healthy economy, actually, inflation will erode the buying power of that pound, so you'll be able to buy less stuff with it, but it'll still be £1. Now, people are thinking, well, of course it grows. What about interest? Well, yeah, sure. So the pound that you have in the bank might produce interest, not a great deal at the minute, but interest is actually income thrown off by your pound. It's new pounds and pence, right? The pound that you've got to start with will always remain £1. How many times can I say pound? If, however, you buy £1 worth of shares in a company, well, actually those shares can increase in value. They might become £1.50 worth of shares or £10, who knows? They have the potential to increase and decrease in value. And on top of that, most real assets also produce an income to a greater or lesser extent. So that's 2 strings to your bow now. Both a potential increase in value of the thing you have bought with your pound and an income. And we call the combination of capital return and income yield, we call that total return. Now, if interest rates are higher than the rate of inflation, then actually you can increase your wealth by keeping money in cash and stockpiling the interest that it produces. But if, as is more usual, interest rates for money held in the bank are lower than the rate of inflation, then you're actually losing money on any wealth that you keep in the form of cash in the bank. Now, as new accumulators, we are looking to build wealth for the future, and so we simply must invest. So let's look at the kind of assets we can buy with our pounds. So the first is equities, and for most of us, this is where the magic happens. Excuse me. Buying equities, otherwise known as shares, is a simple way to build wealth for the future, and it comes with a lot less grief than, say, owning property and becoming a landlord. We'll get to property in a bit. When you own a share in a company, you're entitled to a few privileges, if you want to call them that. So you have the right to vote in company affairs and decisions that need to be made. You delegate the day-to-day running of the company to the board of directors, but they are answerable to you as a shareholder. But because you delegate to them, you can't just dive in and start bossing around the sales teams or redesigning logos and stuff, right? That's a delegation to the board of directors. But you own the company, and you are entitled to vote on certain company matters. If the company makes a profit, it might declare a dividend, and this is your share of the profit, which you get to enjoy. It's an income. Most people who are accumulating wealth, instead of spending and enjoying those dividends, use them to buy more shares, and you can accelerate the compounding of your money by doing so. If the company does well, its share price will rise. Right? Actually, there's two factors at play, really, in the price of any asset which is traded on stock markets. What we call the fundamentals of the company, what it owns, what it owes, stuff like that, and the wider economy, the fundamentals, and then also the sentiment of investors. Ultimately, share prices are driven by supply and demand, and while supply is usually fairly fixed, there's usually a finite number of shares in existence. Now, it changes now and again, but usually there's a finite number of shares in existence. Demand will be based on those two factors, the fundamentals of the company and the economy, and what investors feel about that company. Importantly, you can't influence either of those things, really. So the fluctuation, the volatility in the price of your shares is something you're going to have to just observe, a little bit passive, really. It's not a lot you can do to do anything about it. Shares are really easy to buy and sell. We'll get a little bit into mechanics later, but the term we have for an investment which is easy to buy and sell at any given time, the term we use for that is it's liquid, all right? And this is generally a good thing with investments. So that's shares. So let's think about bonds now. Now, bonds are the most traded kind of asset in the world by a country mile. You'll also hear them called fixed interest or fixed income investments. Sometimes they're just called paper, which is a bit weird. Essentially, a bond is an IOU. So if a company or a country needs to raise some money, it might issue a bond. You, as the investor, you buy the bond, and in doing so, what you're doing is you're lending your money to the issuer. So let's say it's Marks and Sparks, right? They want to open a new store, and so they will use your money that you've given to them or you've lent to them via the bond. They might use it to open a new store somewhere or whatever. What they do with it actually doesn't really matter. It's what you get out of it as the investor that we're interested in. So you will get a fixed income each year called the coupon, and you'll get it for a finite period of time until the redemption date. And at that point, you'll get your money back, exactly the same as you invested. So that's all really simple. But these IOUs, these bonds, are traded on the stock market. So you might have lent Marks and Spencer's £100 and you might have a £100 bond with Marks and Sparks, but you could sell it on the stock market and maybe somebody will buy it from you for £110. So you've made a £10 profit. At that point, the person you've sold the bond to, they are now the lender to Marks and Sparks. You've had your money back. They get the income from that point and they get the £100 back at the redemption date. But hang on, why would anybody buy something for £110 when they know they're only going to get £100 back? That's a guaranteed loss of capital. Well, it might be that they're after the income primarily. Maybe they want to, buy. They want to buy a bond so that they have a guaranteed regular income coming in, maybe to pay a member of a pension scheme or for some other reason. Bonds really are about the income primarily. They tend to be less volatile than shares in that their capital value tends to go up and down less severely than shares, but that's a massive oversimplification. Like most asset classes, bonds, they come in many different flavors, shall we say. So, lending money via a bond to my little company, Jackson's Wealth, whose office I'm standing in right now, that's a much riskier deal than lending money to the UK government, okay? You do that via a special kind of bond called a gilt. Long-term bonds, where you're lending money over a long period of time, behave different to short-term ones. Bonds issued by companies in Argentina or some other emerging economy are likely to be much more risky than a similar bond issued by a company in, say, Germany. Now, most usually, bonds are used in a portfolio of investments to kind of temper the risk of the equity portion. But listen back to last week's show on more on what investment risk actually really means. The risk that you might lose money investing in bonds is mitigated to some extent by the income that they produce. So the capital value will go up and down, but they produce an income, and that offsets that to some degree, but not completely. We'll talk a little bit later about putting it all together. So let's talk about property. Property is special, there's no doubt about it. As I said earlier on, it's tangible, it's real. We kind of understand property naturally, and that's really powerful and is definitely a factor in its overwhelming popularity. Generally, property increases in value over time, and of course, it can produce an income in the form of rent. Property usually can't be held in any of the main tax wrappers like pensions or ISAs, certainly not residential property where people live. You can hold office blocks and car parks and shopping centres and stuff like that inside a pension if you're so inclined. But that's an important consideration because most people understand residential property, not commercial property. Property is also illiquid by definition. Wealth which is tied up in property can't necessarily be easily realised in a short space of time. Okay, it takes a while to sell a house, right? You've got to engage an estate agent, and you've got to find a buyer, and then you've got the whole legal conveyancing process. In practice, though, that's rarely an issue for intelligent investors because they'll always keep enough money back accessible so that they don't have to sell a property, subject to the unforeseen, of course. As we discussed last week, that is actually a key message for investing in any kind of asset. The last thing you want to be is forced to sell when you don't want to, or when doing so will crystallize a paper loss into a real loss. The last thing you want to do is to be forced into that. A key benefit of investing in property is the ability to use leverage or debt to buy more of an asset than you might otherwise be able to. Leverage multiplies investment growth much faster than investing without it. Let's say you've got £100,000 to invest. You could buy a property for that amount. Ignoring all costs and tax for the purposes of this, let's say it increases in value by 25%. So it goes up to £125,000. You've made 25 grand profit, not too shabby. But now let's say you take your £100,000 and you borrow £300,000 on a mortgage to buy a property which is worth 400 grand. Well, if that property goes up by the same percentage, it's now going to be worth 500 grand. So you sell it. You pay back the loan, and you're now 100 grand in profit, not just 25, right? Of course, there are costs involved, and it's not quite that straightforward. Obviously, you'll have to pay interest on the loan while you have it. But the leverage, the debt involved actually amplifies the growth of the asset. It accelerates your wealth building as a result. Now, it's easy to borrow on property because it's tangible, right? The lender understands there is a physical asset there. Worst case, the mortgage company can repossess the property, sell it on to get their money back. But quite likely that would result in a total loss for you, the investor. So obviously that's not ideal. While it can potentially magnify the returns, going into debt in order to invest also magnifies the risk. So it's really important that you understand that. Weirdly, it's considered dangerous to borrow money to invest in the stock market, but normal to do so to invest in property. So it's odd, really. But part of that, I think, is the somewhat flawed assumption that property always goes up in value. It doesn't. But a larger part is the fact that people understand property and they don't understand shares, right? But actually, I don't encourage people to borrow money to invest in shares. Leverage is risky, but it's potentially beneficial. Property as an asset class is great, it's unique in its appeal, but it isn't panacea. It's not the answer to all your wealth building questions, right? It's one of them. Couple of other things to look at. Firstly, commodities, really important asset class. Commodities is really anything that humans consume, right? And it takes in everything from gold and silver and other metals to soft commodities like wheat and sugar to fuels like oil and gas. A crucial thing to understand with commodities is that they don't produce an income. All right, a bar of gold doesn't sort of throw off gold dust as interest. It just kind of sits there. It's inert. And its value is dependent entirely on the whims of the market. So we're back to supply and demand again. Commodities generally are very volatile. Don't believe anybody that tells you the gold price or that investing in gold is a safety net. It just isn't. The price of gold can swing around massively. And you don't have the income part of the equation to sort of offset that at all. Commodities behave very differently to other asset classes. They are volatile. It's not uncommon for you to see the value of gold or oil or whatever halve or double in value. So really you use commodities for a very small part of a portfolio, if at all, and usually they're there as a diversifier, right? Finally, just some other asset classes. Let's just wrap things up with a bit of a quick roundup of some of the minor asset classes. Firstly, we've got private equity. That usually involves buying shares in companies whose sole mission is to buy and sell other companies. In a healthy economy, that's a fairly buoyant asset class, private equity, but can be very volatile though. Often that's part of startup companies as well, so smaller companies with great ideas who need capital to build out whatever it is they've invented or created or whatever. It can be really volatile. You can lose and gain a lot of money in that asset class. Infrastructure is next. That usually involves buying shares in companies who benefit from the relentless march of development around the world. Somewhere there's always a road, a bridge, an airport, or a mobile phone network being built or upgraded around the world. The infrastructure asset class seeks to benefit from this. Hedge funds is another asset class, a little bit weird. Hedge funds involve you, the investor, buying shares in a hedge fund. It's a kind of a vehicle for investment. And they use mechanisms to benefit from share prices going down. You think, well, that's a bit weird. It's actually quite simple. If I think that shares in company A are going to fall in value, well, I can ask somebody who owns those shares if I can borrow them. Lend me your shares in company A, and I will pay them a fee for doing it. Like, I'll give you 50 quid, just lend me your shares for a couple of weeks, right? And so I sell them. I sell those shares on the stock market, and then I wait for the share price to fall. And when it does, now I've got cash now, remember, because I've sold the shares. When the share price falls, I buy the same number of shares back again, but now for a lower price, and I give the shares back to the person that lent them to me, and I get to keep the difference, all right? Of course, if I'm wrong and the share price rises, the lender now is going to ask for his shares back, and I've got to buy them at a higher price, and so I lose money on the deal. So hedging essentially is betting on a falling market. Risky, but can be useful in small measures in a portfolio. Now, there are other asset classes, smaller subclasses if you like, but that'll do for now. So we've covered the biggies: equities, bonds, property, commodities, and a couple of the other stuff. Let's just have a look quickly at putting it together. Okay, for most of you listening to this or watching this on YouTube, the focus of your investing should be on shares. When it comes to building nimble wealth for the future, wealth that you can get at easily, equities, shares is where it's at. Listen back to the episode with Lars Kroyer from a few weeks ago. He says it way better than I can. Read his book, Investing Demystified. There's links to both in the show notes. He presents a really compelling argument for equities being the focus of your investing for the future. When you invest in equities, you are investing in the great companies of the world. Capitalism is the best system that we as humans have evolved to make money grow over time. And as long as we are buying and selling stuff from and to each other, the value of companies that engage in that will continue to rise. Okay? So investing shares, that should be your focus for your investing. That should be the core of what you do. Secondly, track markets using funds. Don't buy individual shares. All right, long-time listeners will know that I believe that buying individual shares, so choosing which companies you're going to buy shares in, is a massive hassle and it's more risk than most people need to bear. Practically, you'll be swamped with paperwork if you buy a lot of individual shares. It can be really hard to keep up with it. The large swings in the price of individual shares is also pretty scary sometimes, likely to make for something of an uncomfortable ride. So I always suggest that instead of choosing what individual shares to buy, because you probably don't have the expertise to know how to do that even, instead of doing that, you just say, well, if shares is where I need to be investing, why don't I just buy like lots of them? All right, and you do that using a fund. So you're buying the asset class rather than the individual asset, essentially. And you do this by buying index tracker funds or their closely related cousins called exchange-traded funds, or ETFs. These aim to follow or track the market by buying every share listed in any given market. So if a fund is aiming to track the FTSE 100 index, the fund will buy all 100 or so shares, companies in that index, and try to buy them in the same weights as they comprise the market. It really isn't making any decisions about which of those shares might do better. It's just saying, I think shares as a whole will do well, so I'm just going to buy them all. All right? And this lack of decision making generally reduces costs. You're not paying very highly paid fund managers to make these decisions for you. We call that passive investing, something I talk about a lot here. I'm not sure really passive is the best term for it. It seems a bit negative, that, but passive it is. Okay? So track markets using funds, don't buy individual shares. There's a shed load more stuff on that on Meaningful Money in past episodes. Third thing you need to do is to blend assets to manage risk. Now, the practice of combining assets or asset classes into a portfolio is called asset allocation. I'm going to have to pause a little minute here for a drink and to cough my guts up. Bear with. Can't believe I just said bear with. What am I, a teenager? So the practice of combining assets into a portfolio, which is a combined asset sort of collection, if you like, we call that process asset allocation. There's loads of studies into this, but it's widely accepted that asset allocation is one of the largest factors which contributes to the success or otherwise of your investing. Now, conventional wisdom is that the greater the equity content, the greater the amount held in shares of your asset allocation, then the higher the risk or the volatility of that portfolio. As we learned last week, risk is really important to your future wealth, volatility. We mustn't shy away from it. And as we'll learn over the next couple of weeks, it's our behavior as new accumulators, which is a much bigger factor in our investing success. The difficulty for novice and experienced investors alike is that volatility has the ability to trigger behaviors in us which might detract from our success as investors. So I can write thousands of words about how risk is necessary, how it's a good thing, it's a lever we can pull, and how we should embrace it. If that same risk or volatility leads you to lose sleep and eventually to make a bad decision to sell investments just to stop the pain, then I've done you a disservice. So I'm going to be attempting next week to try and help you find some kind of a balance between an acceptable level of risk that you can live with and which will also help us achieve our goals. It's a fine balance to walk, believe me. So stay tuned for that challenge for me next week. And last thing, just in putting this together, is consider using a platform to invest. So this is about the mechanics of investing, really. If you're going to use funds like trackers and ETFs to invest, like I just suggested that you do, you need somewhere to buy them. Okay, right? You can't walk into the corner shop, your local Londis, and can I have an ETF, please? Usually it's achieved by using an investment platform, and there's loads of them available these days online. To save you a ton of time researching the available options, I suggest you download a free copy of a guide which is produced by my friends at the Lang Cat Consultancy. It's due an update this summer, but it's still really relevant. There's a link in that in the notes to that. And you need to choose your platform based on a few factors. Cost is one, obviously. Percentage-based fees are better for smaller investment amounts, fixed fees for larger amounts. Some fixed fee platforms also charge dealing fees, so you need to factor that in. Chances are you're not going to be trading that much, actually, but make sure you know, for example, what the implications are of a regular investment each month. Are you going to be charged a trading fee each time? What about the reinvestment of dividends? How does that work, right? Know the costs before you invest and before you choose your platform. Ease of use is important. You want to easily be able to see what's going on in your account, to trade if you want to do that, to get info about gains and losses and stuff easily. Maybe have a good app that you can log into on your phone. So a system with a good user experience is a must, in my experience. Financial strength is important. You want to make sure that the platform you choose is well established. You want it ideally still to be there in a few years' time. Not that they can get hold of your money, if they go bust, but it's just a hassle you don't need, really. Research tools. There's thousands of funds to choose from, so some kind of filtering and research tool will help you narrow down your investment choices. These are the things which you need to look at when choosing an investment. So, folks, that's a fairly whistle-stop tour, really, of asset classes. What are we, 26 minutes in? Asset classes and blending them together. Now, I have a course which takes this to the next level, including allowing you to watch over my shoulder as I research funds using the free tools on morningstar.co.uk. All right, so the course is at learnhowtoinvest.co.uk. Don't forget to use the coupon code podcast25 to get 25 quid off. Right, learnhowtoinvest.co.uk really does take this to the next level, including how to review a portfolio once you've built it, when and how to do that. So loads of great value. More than 200 people have sat that course, and great reviews from it. Speaking of reviews, this is a review from Danger Mao. So either he ran out of space for his name, but I don't think so, or her name. Danger Mao says, an essential investing podcast that makes the complex seem simple. I've often found the world of finance intriguing, but was always put off attempting to learn about money matters due to the jargon involved and the fact that I find working with numbers difficult. This podcast really makes the world of money easy to understand and is packed with so much valuable information that is one of the best ways to get started on improving your financial future. Pete's easygoing presentational style also makes the show enjoyable, whilst also allowing anyone to gain a better understanding of what initially seemed to be an unfathomable subject. Thank you so much, Danger Mao. I'm really glad you got value from it. I'm glad it's eased your journey into learning about money. That's why I'm here. So thank you for taking the time to leave that review. If you want to do the same, it really helps, folks. Keeps me near the top of the rankings. If you're of an Apple persuasion, meaningfulmoney.tv/iTunes is the best place to go. But wherever you're listening, leave me a review or a 5-star rating if you can. It really helps and helps more people to hear about the show. Don't forget, I'm going to be doing a Q&A session at the end of this season to sort of round things off. So get your questions coming in about that. I'll be writing that in the next 2 or 3 weeks. All about the challenges of starting to build wealth, the subject of this season. Get your questions in about that. Season 14 at meaningfulmoney.tv is the email address to send them to. Season 14 at meaningfulmoney.tv. Okay, next time will be the first of 2 weeks talking about behavior. Easily the most important subject of all when it comes to building wealth as a new accumulator. The lessons over the next couple of weeks are going to serve you really, really well into the future if you learn and apply them early. Behavior really is where it's at. The rest is detail. The challenge when it comes to investing is managing ourselves, believe me. So good stuff coming next week. And that's it for this show. Thank you so much for joining me. Hope that you found it useful. If you've got any questions, any comments relating specifically to today's show, or if you want to get any of the links and stuff that I've talked about, go to the show notes, meaningfulmoney.tv/NA6 for New Accumulators episode 6. Hope you enjoyed it, folks. Thank you so much for listening. I'll talk to you next week.